Good morning, everyone. Before we go ahead and jump into it, I want to, you guys know the drill. Just want to do a quick little sound check. If you can hear me all right, just go ahead and type a Y into the chat. Beautiful. All right, so I'd like to welcome everybody to our Tuesday webinar. If you've been on for the last two, you know, or kind of get the gist of what we've been doing recently. We're trying to have some pre-planned content to go through. So when I hand it over to Wade, he's going to plan on going through liquidity lines. So he put together a little presentation about it where we're going to really do a deep dive into liquidity lines. And it's basically a precursor to information that's going to end up into the online course. So we are going to be taking all of your questions and everything, but we're going to do that after he gets through all of the material. So just like, some of the last ones, if you have any markets that you're looking at or, things that you'd like a little bit more info on, feel free to type them into the chat and we'll get to them. We'll go ahead and switch to some different markets and take a look at what's going on just to kind of help out with some forecasting and what's going to happen. So all of that being said, I'm going to hand it over to Wade. Oh, and one more thing for those of you that are new on, this is more focusing on trading theory, stuff like that. As far as technical support, this isn't really the place for that. Try and keep that to the technical support unit inside of the online course. Anyways, so with all of that being said, I'm going to go ahead and hand it over to Wade. Thank you.
All right, Shane, thank you very much. All right, guys, I want to welcome you to the webinar this week. Got some new people on. Had a lot of growth over the last few weeks, so I really want to take a moment to thank you guys for the new subscribers, or thank the new subscribers for getting on here and taking an active part in the webinar. So we've been hearing a lot of exciting things, a lot of good feedback from you guys, and it's been really cool. So anyway, happy to have everyone on board, old subscribers, new subscribers, and we're happy to move forward with you guys. So that being said, what we have put together, like Shane said, every week we've been trying to preview some new content that we're building out for the online course. The videos in the online course, I made those like years ago, and after doing so many, we used to do coaching calls when people would first sign up. I did hundreds of coaching calls and got a lot of insight into what you guys really have, what you struggle with, what you see clearly, and things like that. So through the course of getting a lot of that feedback, I've been trying to redo some of the content. Not that what's in the course isn't good enough. It is good enough in there, but I'm trying to get new content together that'll really drill down on things that'll make things a little more clear for you guys. So what we're doing on the webinars, we're kind of giving you guys a preview into some of that stuff that we're making, and kind of testing it out on you. So just to see, what the response is and if it clears things up. So what we're doing this week is we are going to be talking about everything that you need to know about liquidity lines. Now, we've already done boxes, everything you need to know about contraction boxes. That was, I think, 2 webinars back. Then we did everything you need to know about expansion lines. Now, this week, we're going to do everything you need to know about liquidity lines, and that's basically the 3 components that make up action threshold software. You have contraction boxes, expansion lines, liquidity lines. So this week we'll go over liquidity lines. What we're going to cover is the same as the last 2 weeks. How are they formed? What do they represent? And why, most importantly, why are they important for understanding markets? Okay, so we'll get into the material here. So how are liquidity lines actually formed? Okay, liquidity lines are left behind every time there's a new expansion line formed. So you guys will notice when you look at your charts and you see a new white line pop up, it will always be accompanied with a liquidity line. So we got pop-ups coming up on my computer here. Okay, so it'll always be accompanied with a expansion line will be paired with a liquidity line. So you'll always see that happen. The difference between expansion lines and liquidity lines, though, is expansion lines an expansion line will stop when a new expansion line happens right after it. So they connect, the expansion lines connect to each other, starting and stopping with each other, whereas liquidity lines go on forever until price challenges that price level again. So that's a difference in kind of how, because they do come up at similar price levels, but that's a difference in how they paint. So if an upward expansion, if it's in an upward expansion, a buy liquidity line will be left behind. So this means it's expanding out of a box or without a box or with a box, it's expanding upward, the price movement, and that'll leave behind a green line, and that's a buy liquidity line. Okay. And then the sell liquidity line is the opposite. If it's a downward expansion, the sell liquidity line will be left behind at the top of that. So, and with just real quick, buy liquidity lines and sell liquidity lines, what that's telling us is that's what we want to do at those levels, or if it makes sense in the current market. That's buy liquidity for us, or sell liquidity for us. What it means is that the masses or the people that are getting stopped out at those levels, they're doing the opposite. They're wanting to buy or wanting to sell, and we want to buy or sell with them. So kind of, we'll dig into it deeper, but understand it's buy liquidity line and sell liquidity for basically for smarter traders at the end of the day. Okay. So what do liquidity lines represent? Liquidity lines represent the sensitive price levels where traders will be pressured to close their trades. Just what I said. These lines are going to pop up at levels where we know that if floods of traders opened a bunch of buy positions or a bunch of sell positions based on market activity, this is going to be a footprint left behind by them, where this is ultimately where that belief is going to be challenged. And we know based off of price action that they are going to be, whether they have a stop loss in or not, they're going to be uncomfortable, and it's going to cause a lot of people to say forget it, and they're going to want to close those trades. So red lines are where traders will close out their previous sell positions, causing a flood of buying liquidity to enter the market. So if you have the red line, you see the sell liquidity line here. That's where traders had previously sold the market. In order to close that trade, they are going to have to buy, which is going to cause a flood of buying liquidity or buying demand entering the market, which creates an opportunity for smarter money to sell. As they get stopped out, creates an entry opportunity or an exit opportunity, depending on what's happening in the market. And then green lines are it's the opposite. So hopefully you guys get the idea. It's just green, buy liquidity, red, sell liquidity. Just whether price is moving down or it's moving up, that's going to be what defines the color and how they're left behind. Okay. Pretty straightforward. Okay, so we got an example for you here. So we see price moving up here, and we're going to look at two contraction areas. So we have a contraction box here, and just for the sake of ease, we're going to call it trader one. So trader one is going to buy on this breakout. Okay, you see where the arrow is pointing down. So trader one is going to buy on the breakout, and then that green liquidity line left behind is going to be trader one's breaking point. And think about it for a second. If you're watching the market, you're watching these candles, and you saw that breakout long, you're going to feel like, okay, the market's, you're visually seeing the market is moving up, or it had moved up. So it's going to make you want to say, you know, if you think it's the bottom of the trend or a reversal or whatever, you're going to want to buy the market. Okay, that's just natural because you see it happening. But that liquidity line is going to be your breaking point. Think about it. If you bought where the arrow's pointing and price got down to that green line, think of how would you feel? It's real simple. You'd feel uncomfortable, and you'd want to say, forget it. Okay, maybe the downtrend is still in effect, right? It's a real basic concept. Okay, so now we got another contraction box. Trader two is now going to buy, because now we're getting more confirmation. The uptrend is forming. It's visually happening. So now trader two is going to come with a breaking point. That's that liquidity line that's left out of that contraction period. Okay, so what ends up happening a lot of times, which completes the story, is you're going to get a situation like this, where the market rolls down, and you'll see that trader two sells for a loss, trader one sells for a loss, because their breaking point, their comfort zone, their pain threshold is getting pushed on. And this is going to be it's going to be much more true for inexperienced traders who just don't have a feel for how the market, you know, stops people out. The longer you trade, eventually, whether you heard this from us or not, you're going to eventually pick up on that the markets, they go for stop levels. Okay. And that's what this is representative of. So trader two sells for a loss, trader one sells for a loss, which creates, if they're selling, it creates a buying opportunity at that level, right? So in that case, the market maker or the smart money will buy. They're able to buy at that level at a discount because ultimately everyone believes the market is going up at that level, even the market makers. So that creates that buying opportunity. Sure enough, it rotates. Now, here's the funny part is that trader one and trader two both sold for a loss down at the bottom, but due to the inexperience, they now see the market moving in their favor. They jump back into the trend because now it's okay, it's really going, right? Which then creates more liquidity for the market maker to sell now at a profit. So they were able to buy as trader one and trader two were losing. And now as trader one and trader two are re-entering the market, buying, that creates a selling opportunity to scale out of that position, which creates the cycle of buying and selling. And basically what ends up happening is that the less experienced traders that jump trades and aren't aware of these behaviors are going to constantly be buying and selling at the wrong levels and consequently end up being the fuel of the market. They're going to be the fuel that the more experienced trader is going to play on. And this doesn't necessarily mean that it has to be a retail trader. Okay, a retail trader is kind of like everyone picks on the retail trader just because they come off as they fall for all the they go off of other people's analysis on CNBC and they just kind of follow the crowd. But there's some really smart retail traders out there, and then there's also some institutional money that can act very dumb. So it really comes down to how that trader, whether they're institutional, whether they're retail, is actually behaving and whether they lose their mind or not, even if they know what they're supposed to do. We all fall victim at some points to price snaps in this type of situation. And we see the price activity and we see it going. And there's a possibility where you may even if you understand this is the model of the market, you may make the wrong decision, and that's just our imperfect nature as humans. But the facts are is that the more you become you recognize that this is the activity that really powers the market, you can snap out of it quicker, step back from the chart, look at the whole thing as what's going on, and then you can reconnect to the business, that constant cycle of money flowing in and out, and the market makers controlling the floodgates of that liquidity and following their cycles. Because at the end of the day, they allow the market to move or not based on how they manage their book of business, how they're managing their risk, and how they're going to hedge their positions and allow the market to trend. And they control all that because it's all mediated through a market maker. So by attaching ourselves to their cycles, it's the most surefire way to put any kind of predictability to the randomness of the market. And when you combine that with a trend direction, then that adds much more probability to our favor as well, like what we teach in the basic strategy. So I don't mean to ramble on, but hopefully you guys understand this. This is the cycle that's happening. And ultimately going back to liquidity lines, those are mapping out those breaking points. And at those breaking points, we get information. We get information to decide what the story is. How is price reacting at those levels? And that will tell a story of what is potentially going to happen so that we can come up with an accurate understanding and a good game plan for ourselves. So, okay. Let's go on to the next slide here. So why are liquidity lines important? Well, I think I just understood, or I should probably just explain that quite a bit, but keep going. So liquidity lines play an important role in understanding the market maker's risk profile. Okay, so going back to the same example, remember from last week and the week before, talking about boxes and expansion lines, those are market maker balance points. It's proved by the price action. ATS is not, we're not trying to predict and guess. We are letting the price action define the market. We're letting market interpret market. We're not trying to do it, trying to impose our own settings and models on it. So it's those balance points are confirmed, and they're there, confirmed by price action. Now the liquidity lines become an unbalanced point, and the only way to make a profit trading is you have to become unbalanced at some point, which means you're going to take on risk in a biased direction. And the market makers are able to do this. Their existence in the market, their role is to, number one, facilitate trading, take on client business for the bank. That means when a client calls up a market maker, whether it's through an electronic dealing platform, or if they're trading size, they're going to pick up the phone and they're going to call the market maker, which still happens today if it's a big enough size. And the market maker's job is to make a market. Okay, their job is to take that trade and figure out how to take on that risk and either hedge it or take it on with as little possible risk to where they know they could unwind the position or get rid of it on the interbank market if they need to. So they have tools at their disposal to be able to do this. Those liquidity lines left behind are going to be unbalancing points for the market maker. So if the market maker thinks the market is going to go up, they can allow, based on how they adjust the floodgates of liquidity and how they manage their book, for the market to fall to those unbalancing points, because those unbalancing points actually become areas where their book will naturally fill. In this situation, naturally fills with buy positions. You have a lot of traders that previously bought. Selling demand comes into the market because they want to close their positions, and so it'll unbalance. It becomes an opportunity for the market maker to unbalance their book in a trending direction and actually make money from proprietary trading, rather than always just keeping an even buy and sell. Because at that point, if they're only buying and selling and transacting business and collecting spread, I mean, they are making the spread, but they don't really have a chance to make money off price movement. They have to eventually take on risk, and they're able to do that at these points. So anyway, it's just all telling the story. And then as the market rises, like we saw in the previous illustration, retail buying or just money comes in rushing to buy the market as it goes up, and then the market maker's book naturally fills with sell positions, and it can rebalance as the trend furthers until eventually they become even, and the buying and selling demand evens out, and then we get a new box. Essentially, that's the ultimate balance point there. So hopefully this kind of clears things up a little bit and helps you guys understand the importance of liquidity lines on that level. So another thing why they're important: market entries and exits become based on available liquidity for market movers and not our own models. Again, that's what ATS is all about. It's about, you'll hear me say it over and over, it's letting the market define the market, not our settings, not our models. We're dealing with what price action has created. Whether we like it or not, that's what it's created. And that's what gives us a stable platform to make decisions with. So another example, this is just taken off of, it's actually just a recent gold move. But looking at kind of the basics of how this is unfolding, you have a situation here where you got these green liquidity lines forming at the bottom. Now, market movers, when I say market movers, these are people that actually have enough size to trade to actually change the fundamental direction or sustain a fundamental direction on a higher time frame. Okay, they're not people trading off a 1 minute chart. So market movers are able to buy the market with plenty of available selling demand. That's a key thing. When you are a market mover, you're that significant of size. A government even trying to stabilize its own currency, or a big investment bank. You're worried about liquidity. You don't just jump in and out of the market. You can't. even though Forex is a huge liquidity pool, when you're trading that big of size and managing that kind of money, um, you have to worry about, who's on the other side of the trade? Is there someone willing to buy and sell, or is there enough people willing to buy and sell at those levels? So you're much more interested in what the offers are on the table, liquidity wise, not necessarily the price pattern. So at these levels, with those liquidity lines being representative of batches of liquidity being released in the market, uh, that's where they're able to transact. They can't, when the market takes off, you can't dump $5 billion into the market on a buy because you say, oh, it's going. You have to be much, much, much more calculated, and sometimes build a position to turn the market, because you can't put it all on at once. You'd snap the market, and then it would snap against you immediately. You would change the dynamic of how it's rotating. So you have to go off of available liquidity and build over time when you're moving size. And that's why it's so significant to look at higher time frames, because it's representative of bigger, slower moving money. That's the advantage of having multiple time frame analysis. That, not to get off the subject. So anyway, market movers they're able, that's the key word here, they're able to buy the market with plenty of available selling demand. Demand wants to come in, wants to sell, other side of that's a buy. Now, as the market moves up, the market movers are now able, again, keyword, they're able to scale out of their positions with plenty of buying demand. And then all the orders in between that, like I said, that's the fuel of the market. That's what we're trying to model when we take a directional bias, we take a higher time frame, and we're looking to buy into that market or sell into that market. Above or below expansion is where it starts. But those liquidity lines help us tell a story, and that's ultimately why they work so good for price targets. Sometimes we won't get a liquidity line for an entry. We're just looking to get above or below our average price, our expansion line. But as a market goes for you, those liquidity lines, that's where any bigger money that is actually pushing that market is now able to start scaling out at those positions. So that provides us with details to the game plan, and it allows us to model, even though as retail traders, you're going to be trading much smaller size typically than an institution, someone who's moving large amounts of money for clients. In global trade, we're not doing that, but that's the money that's moving the market, that's based on the fundamentals. So if you want to really understand price movement, you have to mirror how they need to trade. It's how they need to trade, and that will give you some better understanding into what the potentials are, in the market, and what's going to happen. So hopefully that helps clear that up a little bit. So ultimately, liquidity lines give ATS traders advanced notice of liquidity that will create opportunities and shape future market outcomes, essentially a map of the future. And that's what we talk about. ATS is a map. That's what it is. It's not a buy here, sell here system. It's a map. It's a snapshot of the potentialities associated with current price. And it's something that if price gets to this level, or gets to this other level, what's going to happen, what story is going to be told at that. And then when we combine that with a fundamental direction that's represented on the weekly or monthly charts, or the higher time frames associated with what you're trying to do, then that stability of that time frame, combined with the map, the architecture of ATS on a lower time frame, gives you a huge piece of the story and allows you to put those pieces together in a way that makes sense and is not going to repaint. It's going to be the same thing every single day, every single week, every month, every year. It's the same information because it's based on the dynamics of buying and selling that's happening in the market right now. And so ultimately, you guys who hear me drill this in every single week, that's the value of ATS. Is a stable platform. At the end of the day, that's it. That's the highest value. and the creativeness that allows you. I may see a trade and you might see a different trade, and they may both work out on different timescales. But it gives you that true architecture to really define what is or isn't going to happen. And when the market gets those price levels, those are those defining points. You can make choices much quicker than if you're looking at a lagging indicator or an indicator that's 100% settings based, because that'll always leave in the back of your mind, is this the best setting? You'll always have that nagging doubt or that pit in your stomach wondering, is my system going to fail today? Whereas ATS, it doesn't have those settings. It just kind of, this, you have to approach the market with a clear mind, and from a creative aspect, you have to understand what are the potentials, what can happen, and should these scenarios play out, you come up with a plan for each type of scenario. Whether the trade goes in your favor, where are you going to get out? How are you going to behave when it moves for you? Or if it moves against you, starts going through certain lines, testing certain liquidity lines, levels, reacts at those levels, what are you going to do at that point? So it allows you to come up with those scenarios and plan trading opportunities according to them. So that's what I got for you guys today. Hopefully that cleared some stuff up. Let me pull up my charts here, and then I'm going to look into some of your guys' questions. So hang on real quick. Okay, so give me a second to catch up on some of your questions. I don't know if Shane's, that's the first time he's seen that PowerPoint. So if you want to add anything to that, Shane, right now would be the time.
Yeah, there actually was something I wanted to add. I get a lot of this into the support chat, and regarding all the examples that you just brought up, you didn't specify what time frame you were looking at on any of them, and for good reason, because this all plays out on every single time frame, and the analogy that I like to use on describing it is it's like a small cog spinning a bigger cog, spinning an even bigger cog, and they all kind of work together. So, to those of you that are, wondering about what time frame, any of these examples work on, it's the whole thing. It's every time frame. If you understand it on a smaller time frame, then it'll play into the larger ones.
Yeah, pretty much. It's all. That's one thing is definitely some people definitely a big question that I get as well is what time frames does this work on? And what markets does this work on? It works on everything. Uh, it's the same. It's all based on price. It's all based on behavior and how business is transacted, and that's what allows it to conform to markets and give us the same predictable information. And if the information isn't clear, the best thing to do is don't do anything. We have the advantage as traders that we can't control the market, how it moves, when it moves, how big it moves. We don't control any of that as individual traders. But what we do control is we control the risk we expose ourselves to and the opportunities that we take advantage of. So, I know as traders, you wake up, at least for us, early in the morning or wherever you're located in the world, and you feel like you want to be productive. Like I need to find a trade. I got to get into something. But that's sometimes being productive means not doing anything, because if you don't find something that you understand and that you've calculated a plan for where you think price is headed, for your profit, or if it goes against you, what you're going to do. If you don't see a clear, definitive way to interact with that, then there's probably no trade. At least for you. Because if it's something that you can't manage and you can't mentally work through before you ever push the button, it's not your trade. So something to keep in mind. Sorry, I'm still reading through questions here. So guys, give me one more second here. Sorry, guys, we got flooded with a ton of stuff here, so I'm trying to. Guess that's the problem with letting questions build up while we're doing a presentation here. Okay, question about trend lines from Avery. Thanks, Avery. Um, okay, so the question is, I know you don't believe in trend lines, but when the market changes direction, is it a good idea to put a trend line there to be able to spot when the direction is about to change? That's really the trend lines are one of those things that there's so many different lows and highs, and you'll have one half of traders that say you need to put the trend lines at the bodies of the candles, or you need to put the trend line, the other half will say you need to put the trend lines at the tip of the wick. And ultimately it's like, it's one of those things you can move it, and it's one of those things that can almost never be perfected. I get where you can look back in history and see like, okay, I put the trend line here at this level and look at how it held above that trend line and kept testing it and bouncing and bouncing. But ultimately, if it doesn't work out, then you're going to be saying, well, did I really place my trend line right, or it leaves so much open. So by just looking at a higher time frame, and it's something as simple as the color on the Heikin-Ashi candle is a stable enough thing to show rotation. We see like right now on gold, you got a weekly rotation. We're starting to pull green now. That's enough to tell us on a weekly time scale that that we're rotating long at this point. Very, very simple analysis. Whereas the opposite, the flip side of that, is trying to come down with a trend line. And so maybe you could have taken a trend line down like this, and then said, okay, I split off the zone, and then we came through that, and now I got to find, where do I put do I start it from here and project forward like this, or, so it's one of those sciences that can't really be perfected. Whereas we have very simplified information as a rotation here. You combine that, seeing how we're rejecting expansion lines on the 4-hour, you can understand there's a turn possibly happening before it happens right here, just with this activity. So I find the trend lines, like I said, but you combine the fact that it's not an exact science, and I just think that just going off of a higher time frame candle is always going to be better, in my opinion. But if you guys are out there and you find usefulness for trend lines, and you feel it gives you an edge and gives you some sort of confidence, then by all means, trend lined away. So, but that's just my view on it. Okay, let me keep reading here. Hang on. Okay, you got a question from Bruce here. Thanks for the question, Bruce. Let me read it here. I'm going to try to understand a little bit better. So liquidity lines. What if the higher time frame trend is going against what the liquidity lines on the lower time frame are indicating? Do liquidity lines mark the end of the expansion phase? And if not, what is the correlation between expansion and liquidity lines? So expansion is the tipping point between buying and selling demand coming in on a general level. Liquidity lines are what's left behind when people are allowed to potentially show a profit on paper. So right now, we look at these expansion lines here. Anyone that's entered up through here, these levels have not been challenged yet. and they may not be challenged for a while. This may be a rotation for a long time. But what these are is that these are um, leaving behind that footprint of people that have been allowed to be left in the money. If the market rotates right now, you can see that this off this liquidity line right here, these people are being challenged. This is where a new belief structure was born, held below expansion. Even more so here was it confirmed. A lot of traders jumped in short and are sitting in this market thinking that we're going to continue down and trend. So now they're being forced out. And that's what so the liquidity lines are going to hold that position. That's the difference between expansion lines. When you get a new expansion, that's going to track that initial expansion phase with those white lines, but the liquidity lines will be left behind for forever until they're challenged again. So that's the difference between those. So going back, I'm trying not sure if I totally understand the question. If the higher time frame is going against what the liquidity lines on the lower time frame are indicating. Well, you should always be trading with the higher time frame. So right now, the weekly, for example, the weekly, if that's your directional bias, then that's showing us that we're long. Granted, we're against expansion, so there's a possibility this could just be a correction and then we could still head short. That's always a possibility. But for the moment, on a weekly time scale, it's green. There's no getting around that. And it'll probably be green the rest of the week since it's only Tuesday. So the fact that we know that, what you'd be looking for is if you get a situation now where this holds green, let's say the 4 hour or whatever time frame you're seeing this visual happen on, you see that the market's moving, and then all of a sudden, let's say we get a box and now we dip down and you take out a green liquidity line, but you're still green on the weekly. You can come to the conclusion that as long as the higher time frame holds direction, any green liquidity lines that are taken out will be for accumulation purposes to further this trend. So let me say it again. Your higher time frame is green. Any green liquidity lines that are met, we can come to the conclusion that as long as this holds, or it looks like it's going to hold, those become entry opportunities for a better entry point. Traders are getting blown out. It's going to cause a flood of sell liquidity, which is going to create an opportunity for a buying position. So that's how they need to be treated. And as the trend furthers, as we go green, if you get to these levels up here, those are scaling out opportunities. So you think about the liquidity lines that are the same color as the higher time frame are accumulation opportunities in trend. Enter the trend. Liquidity lines that are the opposite color of the higher time frame, scaling out. Profit targets. So hopefully that kind of answers your question. Hopefully I put enough information out there to clear up if I didn't answer it specifically. Okay, let me keep reading here. Okay, question says, please show us step by step how to do a trade entry. Okay, so this is explained in the basic strategy. What we're trying to do on the basic strategy, the starting point before you start looking at this as an overall map and forming your own ideas, is you're trying to find a trending direction. Okay, so let's take the 4 hour. Here's a 4 hour. Okay, and we'll take the 5 minute for right now. We see the 4 hour is clearly long and it's above expansion. So for you guys that are new, let's for the sake of ease, let's treat these expansion lines like a moving average. When you're above, that means that there's buying demand. When you're below, that means that there's selling demand. Okay. What we're trying to do is we are trying to identify momentum on the higher time frame above or below expansion. and then we're trying to catch a counter trend move below expansion in expectation that the higher time frame is going to carry through. So you got your 4-hour pushing long right here. You get the timing of the expansion. It's a down expansion, so it's counter trend to the 4-hour. You're trying to stick your best entry maybe at the rotation on the 5-minute, somewhere in there. You're not going to get it perfect, but somewhere in here, this one worked out pretty good here. And what you're trying to do is you're trying to get back above this expansion line. Now, this had the potential right here to take you up. It held the expansion line, okay? Which is, you may have closed the trade right here, possibly. So this was a little bit more difficult one, but the facts are, remember that no matter what happens, as long as this stays intact, we're eventually going to get up through this level. So let's say you bought here, you close as it, let's say you just get out at break even. Say, okay, it didn't go through right there. Okay, you go down again. Now we're below this expansion level. Okay. As you see price rotate up through, and even as it comes through this expansion level, this whole price activity gives you the same type of clue. As we come up through here, you can trade again against this original expansion. You can buy this breakout because you're still under the expansion over here. And ultimately, if the trend is going to continue on the 4-hour, we're going to get above this line. We come back up through, comes down, holds expansion. Okay, so if you bought right here on the breakout, coming down, it's holding. This again is another clue. Again, like I said, this isn't the easiest situation to trade, but it is what it is. It's holding above expansion, giving us a clue that market maker doesn't need to drive price back down towards this balancing point. They're going to hold, which is going to let the trend flow. As it comes up, you're going to be looking at these points to make decisions. If you're seeing the price is holding at those levels, chances are it'll keep going up. If you're seeing a dramatic reaction from those levels, then we're probably going into a bigger pause. So as price drove up through here, and then you can see we pause, we're above these lines. This is where you'd want to possibly manage your stop loss at. As you get above these levels, you really don't want to go back below them. And so you're basically working your progress with those. Ultimately, we got up to the top here, blew out through here, and then you can see that we draw back through this line and we went into a new box right here. So you're not probably, most of the time, you're not going to get all of this. What we're trying to do is we're trying to do base hits, get below the expansion, get out somewhere above or at expansion, and test opportunities. We're trying to practice timing first and foremost to enter the trend and see how long you could stay in once you start holding above an expansion. And the way that this would have been worked out, you would have had to put these all together. You can't look at one individual one. You had a situation here where you probably got out at a break even. You had another situation where it pulled down but then immediately reversed. That's telling you that this range is still in play. It didn't dive down, because if this would have failed right here and didn't go up, then we probably would have been headed down to here. It didn't happen. It broke out, came down and hold. Even after seeing this break long and seeing this come down and hit this expansion, you could have even bought again right here based on the clue that this gave you. So that's what you have to be willing to look for those clues. And what really gives you the edge at the end of the day is to keep, for lack of a better term, not that we're gambling, but you got to keep your bets in the same direction. This told you that all you had to do was be an expert buyer of the market. So there was no situation in here where you would have saw like this right here and decided, okay, we're holding below that expansion. I'm going to catch the turn. I'm going to sell the market right here. That's where other people would possibly do that. Even using our software, they may fall victim to that. But the facts are the edge and the probability is keeping your bets in the same direction. When your higher time frame says you're long, you are nothing but long every time. So you're long right here, you're long again right here, you're long again right here. And eventually, as long as you keep that directional bias, more times than not, you will end up getting paid. Even if you lose a little bit trying to find it, you'll eventually set yourself up to be in these opportunities. When you spread your bets, when you're going black and red, buying and selling, buy, sell, and you're not married to that one single directional bias, you throw off your probabilities. You make it much more random. You're adding randomness to your approach. So that the directional bias will take that randomness out. And then when everyone else is convinced the market's going to go down, by being stuck in that directional bias, you finally get to knock it out of the park, or you have the possibility to do that. So same thing down here. Here's another possibility on the rotation coming out on the 4 hour. Of course, we were in the box at this point. That's a little bit more difficult of a move, but you're below expansion, get back up, hold above this one. Here it goes. So you probably realistically would have scaled out at this level, but also too, what you can do to predict your profit targets is you can, if you think that this 4 hour, there was a good chance we were at least going to get to this expansion line on this breakout. So you can measure that. If you were trading it down here from the break, there's a 633 point possibility there as a profit target. So if you're basing your exit more on where you think the higher time frame is going to go, and you're early enough to the opportunity, then you have the ability to just ride the higher time frame. That's going to go back to those grade A trade setups on the ATS assistant. You have the ability to enter the rotation on the higher time frame at a good price, and then just ride it to the liquidity level on the higher time frame. That's a decision you can make. So, and it'll, like I said, it'll come with experience and the way the market's set up. You'll be able to make those calls at some point. So anyway, hopefully that helps you guys understand entry. You're looking at the basics, accurately define momentum, or the expectation of momentum, find counter trend liquidity, work the map. Let the map tell you what's going to happen. Ultimately, what you want, if that trend's going to continue, is that you're eventually going to hold above one of these expansion levels and wait for it to explode in that direction. The rest is just fishing. All right. Okay, let me do some more reading here. Guys, we're going to keep this to about an hour. So I apologize if I can't get to your question. You can always send your questions to support@tradeats.com too. And we're more than happy to give you guys feedback that way as well. So if I'm not able to get to it. Okay, we're going to take a look at dollar franc. So let me request to take a look at that, see what's going on. Okay, so dollar franc, we're rotating, first rotation on a weekly candle. So at this point, I would not buy this market. I would only be looking to sell. So from a 4 hour standpoint, if you're only looking at the 4 hour for your directional bias based on, say, a 5-minute entry, these are going to be trades that you're not going to want to leave on past, unless you're significantly in the money, you're not going to want to leave these on past the general New York London session. So looking for a daily opportunity, you're going to go off the 4 hour candle. There was some good short opportunities in here. Clearly defined 4 hour below average price opportunity here. It was a fast one, but there you go. Hold below average price. That one turned into a monster. Same thing up through here, above average price, come down through, hold below, kind of fizzles out. So took more of an advanced pause here. Uh, we held red all the way through here, it looks like though. So even through that pause. So, you know, realistically, you probably would have taken a break here, maybe racked a few pips up through here, but this kind of felt like a rotation. Just, I don't know, I wasn't looking at it, but realistically, let's say you left that alone. I would still only be short because you're red over here. So here's your first opportunity as it goes down. Expansion line. This one breaks out to the short side, hard to catch. So let's say you miss that one. Here it comes back up above expansion. There's an opportunity rotating off that expansion level. Enter right here, get below, hold below, have the ability now to ride through. Once you hold below or above your reference point, say you're selling against this expansion level. The minute you get below and you start holding like this, you know, like right in this range right here, that's where you really don't want to go back above. Let's say the price did break out long, you'd close a trade. Once you get below and you start holding, that's where you've earned the right to let it ride if you want to. It's a good trade based on just getting back to average price. That's getting us in the money, which is the first goal. Just want to get in the money. Second goal is hopefully price will get below that tilting point, hold below, and now you've earned the right to stay in this as long as you want. Same thing right here. You get above expansion, still red on the 4-hour, below expansion, holds obviously, you've earned the right. You can still, if you were in this trade right here, selling above expansion on the rotation right here, you can still be in that trade if you think we're still going to keep crawling down because you're confirmed below. Now, if you get above this line right here, let's say the market spikes up, you get above and you entered right here, you'd be done. You'd get out at a break even probably, or maybe a small loss. That'd be your call. But that once you get above or below that reference point, you've earned the right to let it ride. If you want to make that, if you feel confident that the higher time frames going to continue. One thing I want to point out with this is that when the weekly rotated, you'll notice that when we're entering in trend, and we've done other videos on the webinars, you can see these are all decision points, these previous expansion levels. You can see that we came down, held this expansion level for a minute, but then broke through. That can also be a possibility that we're getting a fundamental direction change because it's showing us that the market maker is now letting price pass through that previous balancing point. And that can give us a clue. So let's say you did sell this market. Let's pretend this was green, right? And let's say that you saw this spike down. You said, I'm going long. I'm going to trade back up towards here on a 4-hour into a weekly type setup. Now we get down to this line. Let's say you're down a little bit. We hold, and now you see this aggressive break. That would be a sign I would personally close those trades. Because if you're starting to disrespect these previous levels, that's a chance that you could be in for a bigger fundamental rotation on a higher time frame. See, in this situation where we came out of this range, it came up and it held the previous level. We got below expansion, but it held right here. You want to see that kind of block stacking effect in a true trend. That's where you know you're getting early into those trades. So when you start disrespecting these previous levels, that's a chance where you want to dump it. Even if this does turn green again, you'll be able to get a better price typically. So now let's say it was still green on the weekly. You can now enter down here. You close your positions, you get back in, and now this is just a bigger reward coming back up to this line. So those lines will allow you guys to make those calls and figure out what's going on. So always look at those previous expansion lines to help tell you the story. Same thing right here. You got above expansion and held. That's showing you that the blocks are stacking down. Got below, now it's holding. Again, holding below, down. Right now, what's ends up happening? Now we're starting to get through expansion. We're getting multiple expansions in the same area. So this could be a rotation point. Again, just putting together the clues. Of course, we're getting out of session right now, and it's probably going to go flat anyway. So
I actually had a real quick example. There's a question in the chat a little bit further down that you can see, Wade, but someone brought up just managing risk. When you've got a situation like the example you were just going through of it going down and about halfway down that run on the 5 minute, how it goes and pulls up above that expansion line, and then that could have been a potential entry point. So Wade, if you want to just hover your cursor over that on the 5 minute, that first expansion line that it pushed, yeah, right there. So when you go in and you see something like that, and then it starts pulling back, you don't have to get in on the other side of the expansion line, and nail a perfect entry. That's like that's really, really difficult to do. But once it gets a little bit down below that, and then you can enter in on a short trade because it held, it pushed past it and then held below, then now that's your what you're basing your trade off of. So your risk doesn't have to be any more than a few pips above that expansion line. So that's kind of how you can manage your risk as you go, even though the trade is already pushed quite a bit. So that, you'll develop new points that you can manage your risk off of. And if it did get up past that, you just take a small loss, and it just kind of is what it is, and you'll just have to wait for more expansion lines, more liquidity lines to develop, and then you can develop a new theory on what you think is going to happen afterwards.
Yeah, absolutely. So that's, seeing this rotation right here, even if you entered on the red candle right here, you got to look at, again, you're coming up with scenarios. Let's say that uh, let's say this never happened. Let's talk about the worst case. Let's say that you entered here on this red, and let's say then next candle turned green and you pushed up. What does that say that we're now disrespecting this level? What does that say about the price? It says that we're probably going into a bigger correction, and that this trend, at least on this range, is starting to fall apart. Now we would be looking for, if we get above, if you get stopped out up here, you enter here, you get stopped out right here, let's say, worst case scenario. What does that mean for the 4 hour? Is the 4 hour still good? Is it not good? It's information. It's a flow of information. If you get up here, and now let's say that you jump up to up here. Let's say it just continued all the way up here, and now we're getting a rotation up off these liquidity lines, off this expansion level, it's starting to hold, and now you see an aggressive rotation, and let's say, for instance, that the 4 hour was still red. We just got a much better entry price up here to test, because the higher time frame would have still been intact. Like I said, these are just scenarios. I know it didn't happen this way on this particular currency, but this will happen as you guys watch stuff play out. So it's a matter of, is the architecture holding, and how is price behaving with that architecture? And that by constantly asking yourself questions, is it respecting the lines? Is it not respecting the lines? That will keep you in real time understanding what the probabilities are in association with the trend. The trend is just gives us the ability to focus on one side of the market. That's the whole point of the directional bias. That gives you an edge by stacking the probabilities in the favor of the trending market. So you don't. The most frustrating thing ever is to understand the trend. You're working the trend. Let's say you miss an opportunity in trend, and you think, okay, well, the next opportunity is going to be a counter trend move. And so you see something that looks like a rotation on your lower time frame, and now you're trading against a directional bias because you're trying to make up lost time. And next thing you know, you maybe get in the money a few pips, which is probably an entry to get into the trend. But now you can't be long and short at the same time. You're married to that belief system now. Now what happens? Okay, here comes a trend now kicking back in, because that's where the flow of money is going. And now what do you got to do? You got to dump that position at an unnecessary loss and try to find a late entry back into the trend. That's the most frustrating situation in trading, in my opinion. So by disciplining yourself to be just absolutely dogged about being a master of the trend, whether you're using ATS software or not, I don't care what you're using. If you're using moving average crossovers, trade them only in trend with the higher time frame. Leave everything else alone. And you may say, but man, I'm missing a lot of market activity, and look at this move and look at that move. I don't care. That is the single biggest thing you can put on your side, is sticking with the trend. It's literally the single most important thing that takes randomness out of the markets. The facts that markets trend is the only edge at the end of the day that allows people to make any kind of consistent gains. And the only thing besides that is going to be like high frequency trading, where you're just front running, which I'm pretty sure most of you guys don't have high frequency trading operations or anything like that. Okay, that's a whole different game. Other than that, as traders, we need trends. We need them. So if you take one thing away from this, become a master of the trend. Manage your trades in the trend. Don't be afraid to take a loss in trend. Think about this. If you're going to lose all your money trading, lose it all in trend and see how hard it'll be to lose it. When you spread your chips all over, you're buying and selling, changing your mind over and over and over again, it randomizes everything. You're paying a bunch of spread, which puts you at the house disadvantage. You're going to eventually get bled dry. So, like I said, if you take one thing from working with us and anything, it's that. Become a master of the trend. Okay, I'm going to see if I could find a couple more questions here, and then we're probably going to wrap it up. So give me one more moment here. Okay, there's a question I think from before. I'm going to address it real quick, saying how is a weekly green if it was below? I think it was talking about when we were looking at gold. I think on this chart. If you're talking about this, Bruce, the weekly candle, those are based on the calculation of Heikin Ashi. We didn't invent that. Those candles are not a proprietary thing of ATS. The only thing that's proprietary is boxes, liquidity lines, expansion lines, and then our assistant and things like that. But the Heikin Ashi candles, that's a function of how they are calculated. And if that's what you're talking about, the price can be green just because that's where the rotation is and what's been triggered on that specific algorithm. Just showing you that you got a directional color change and a possible rotation, just like it rotated here from red to green. You can see that the consistency, the reason why I like Heikin Ashi candles is because they take a lot of the noise out of the market. They're still going to show you the extreme highs and lows, but the fundamental, like something as simple as this, you got a weekly chart. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, like 15 weeks. It was green. It held green. So you take a very simplistic idea like that, that if a market has the potential to trend 15 weeks and hold that color on that candle, which it does, there's a lot of these big runs that happen, especially above or below expansion. If you ground yourself in basic concepts like that, what that ultimately tells you is that there was 15 weeks in gold that all you had to do was buy the market. Now you combine that constant feature that happens in markets with a little bit of thought into your entry and exit on a lower time frame, what does that do for your overall consistency? You had 15 weeks that you potentially were positive in the market. So that's why we like to use Heikin Ashi candles, because they clean up that noise. You're going to get a lot more. Again, what I think is the most difficult thing in the market that people can't get over is being a buyer and seller, over trading. The more noise you have in your charts, the more over trading is likely. So that we use those candles to show you the simple fact that they all held green. Therefore, for 15 weeks, if you were using this as your directional bias, you had 15 weeks every morning that you looked at the screen, every afternoon, every night, wherever you're located, that you were saying, what's the best possible way I could buy this market? That basic thing is such a grounding principle that will keep you from seeing mirages and will put probabilities in your favor. That gives you the edge over the house. So that's why we use those candles, just to kind of expand on that. Okay, okay, we'll take a look at dollar CAD real quick. That's a popular one. Okay, dollar CAD 4-hour chart looks dirty. But when the 4-hour, when your higher time frame looks dirty, look at the higher time frame from that. Right now, I would probably only be looking to trade long on the 4-hour, although we're coming out of session, so I wouldn't do anything right now. But we're above average price. We're just broke out of the box, which tells me that we're probably that's a volatility signal. So this will probably dollar CAD will actually probably have pretty good trading between from Wednesday to Friday, because you got a breakout on the 4-hour, which means that we're going into expansion, which means on that time scale we're going to get swings, which means probably pretty good opportunity for some good trades for the rest of the week. So if you haven't been doing well on dollar CAD, which it looks like it's been pretty hard to do well today and yesterday, stick with it, because I think that again, we're going to move from this level. You got your volatility signal, you got your new expansion. Let's say it holds above that expansion on the 4-hour. Let's say that your next 4-hour candle is green, the next one after that's green. They hold green above expansion into London, New York, London Open, New York Open tomorrow. That's in line with the weekly direction. So a good probability is we do hold above that and we get a run up through these liquidity line levels up here. If that happens, means good trend trading on your 5 and your 15-minute charts, possible entries, just a scenario. But anyway, yeah, I would stick with it. I wouldn't give up on it right now, because it looks like this even last week, there was probably a couple of decent moves in here, but overall, pretty choppy. So, yeah, overall, got a lot of contraction going on here. And what that means is we're going to get an expansion. So if you ever get in a situation where you're in a market and you're trading, you just seem like nothing's taking off. Well, it does happen. Markets are going to take a pause. But if you can spot that and you can lay off a little bit, let it play out, let the markets whip sideways. Also, too, one thing I'm not even thinking about, a big important thing about today, you guys got to remember, we got NFP on Friday. I don't know why I didn't mention this before. I just sent an email out, or I put it on the forum. If you guys haven't seen the forum, one of the responses, but we got NFP on Friday. The biggest number of the month is on the first Friday of a new month. Consolidate, the markets are typically, especially US Northern American based markets, are going to consolidate up until that point. They're going to get tighter and tighter, because all the institutional money is going to be sitting on the sidelines waiting for that. They're not going to want to go into that number with a bunch of risk. So what they're going to end up doing is those markets, it's almost a good idea to not really trade the weeks leading up to NFP, because you're going to get a situation like what you're seeing on dollar CAD, and it's going to be very prevalent in dollar CAD, probably the most. You're also going to see this on Euro USD to some degree, but dollar CAD, everyone involved in the exchange of these currencies is going to be sitting on the sidelines from a trading perspective until those numbers come out. Even if they've already predicted to some degree what's going to happen, they're going to wait to let those come out, and that's going to define the movement of the forecast of the next of December. And there's 4 weeks in December, so that's going to define what happens on the next 4 weekly candles. So sitting out of the market is not a bad idea uh, coming up to NFP on a lot of different markets, um, especially anything tied into the dollar. So maybe on these times you may want to trade something like gold or trade something else that's not quite as reliant or affected by those numbers. So, but anyway, that's what I look for. And saying so, like I said, the possibility that this could go long and there could be some good trading to the long side, I take that back. It's still a possibility. Market could do whatever it wants. I would definitely, if someone said you got to trade one direction, I would definitely be long with the weekly. But there's also a chance nothing can happen. And because NFP is coming out on Friday, that's enough of a discouragement, in my opinion, to stay away from this market. Just my opinion, though. Okay, so let me see. We got any more simple questions? Like I said, guys, if we don't get to your questions, feel free to send them to support@tradeats.com, and more than happy to give you guys feedback that way.
Yeah, also, if you do end up doing that, please send a screenshot with it. Then we can really, get down to business on what you're asking. Screenshots are always very appreciated.
Yeah, yeah. Please send screenshots. Copy, take a print screen of your chart so we can see what you're talking about. If you can even you can paste your screenshots to the Microsoft Paint program. In fact, Shane, we should come out with a tutorial. Note this down. Let's make a tutorial on how to make a screenshot and how to edit it in a basic way on Paint. So I think that'd probably be a good lesson, because that would allow us to help you guys so much more. If you guys can illustrate where you got in, where you got out, or where you're planning to get in, where you're planning to get out. That way, if you guys want the insight, you don't have to, but if you want some insight into what we think is possibly going to happen, we'd be more than happy to do that for you. But we need adequate data to go off of. So anyway, we'll look into making a lesson on that. Okay, I'm just checking a few more questions here. Okay, there's a question from Rick. I think it was back from a different chart we're looking at, possibly gold. Talking about why getting out at a break even if you basically what I think Rick's trying to say is if you feel good about the 4 hour, you feel good about your higher time frame direction, why get out at break even? Why just hold the position as long as the 4 hour doesn't rotate against you? That's a possibility, absolutely. And it's going to depend on the size that you're trading too, because if you're trading really heavy, let's just put it this way: the heavier you trade, the more that you need to be in the money almost immediately. Because if you're out of the money, your pain threshold's going to get pushed. You're going to want to close the trade. So it really just depends on how you want to manage the risk. If the 4 hour, if you still feel good about the 4 hour and you see that your original entry is getting slightly discouraged, by all means, put another position in or keep holding. But like I said, it's really just going to depend on your risk appetite and what you're trying to do. There may be situations where it's setting up and you feel like this is it, this is the rotation, and you want to go heavy on that position and you're ready to get out immediately when you get discouraged. You can do that with a higher leverage used. But that's going to define how quickly you want to dump that if it goes against you. So it really just depends on that. If you're in at a heavy amount and it goes against your original position, and now you're down 10 pips, and now you're down 15 pips, and now you're down 25 pips, and you're at a heavy lot size, that's not something you want to do. So but if you it really needs to just be defined off of the quality of the setup, the managing points of that setup, meaning the previous architecture, the previous expansion lines, liquidity lines, things you have to work with in that entry range. You got to figure out how tight that stuff is. And that'll kind of help you define what the allowances are going to be for that trade. But by all means, if you feel good about it, all these trades need to stem from a point of that you feel good about your higher time frame. If you don't understand or feel good about your higher time frame, that the trend is going to continue when going off the basic strategy, then the time is you do nothing. Wait until you feel good about the higher time frame, you get some confidence in that, and then the entries become much easier on the lower time frame. Okay, I'm gonna glance at Euro CAD real quick. Okay, Euro CAD had a break long. All right. So we're above on the weekly. So this was, talk about one of the grade A setups right here. These are one of those opportunities. You hold green above average price, clearly came down, tested that level, held above. This week opened green, I'm sure above. Okay. If you're running at something like the 4 hour, the 15 and the 4 hour or the 5, and you're looking for the grade A and B trade setups, let's just put it this way. On this type of situation, this is where you want to hang it out. Because you got your confirmed green above average price. You're starting to hold above average price over here. If you can stick an entry in here, I don't even care which one it is. Let's take a look at the 15. A lot of people are trading the 15 and the 4 hour. Okay, so let's look at when you broke out long here, which was the 1600 candle. So what's after 1600? Okay, here's a spike down, 14. Okay, so it's going to be in this neighborhood. Okay. So here's your possible grade A setup on the assistant. And if that didn't trigger, let's just say, for instance, the candle was red because it's going to look at the candle color, then you had at least another grade A or grade B. Right here, that's where you want to hang it out. Why? Because in this way, I tell you guys, you got to look at, you don't want to trade the ATS assistant blindly off of buy signal, sell signal. When you get those signals, and let's say you weren't paying attention to this market, but you're running the 15 and the 4 hour, with the 4 hours, you're supporting time frame, and you get a grade A signal when you break out short of this box. You say, okay, I'm gonna go take a look at it. I see, okay, 4 hours green holding above, that's a good sign. So it's in trend on the 4 hour. Oh my gosh, okay, we're early to the 15-minute or to the weekly rotation. We already had this. Okay, this is what I'm talking about. That's an opportunity. If this is a pair you're monitoring, not that you won't trade some other grade A and grade B opportunities, but this one looks really good at that point. You're early to what could be, well, what happened? That's a potential, and your risk is like right here. So if you're only trading grade A opportunities and you look at them and they look similar to this, or you feel good about the weekly's in a heavy trend, and you see that you can manage your risk based off of holding this average price, that's how you define your risk and your potential reward. Your upside is, well, the upside is the explosion of the weekly chart. It's the active high. I mean, your upside was you're gonna, if this holds above this average price, you're at least coming to here, just like we're doing, which was the high right here. But you could have managed that in a tight range. You could have stuck an entry here. You could have layered on here, because those are both grade A, grade B opportunities, and manage your risk below this line, which would have been, what's the price? 1.4615 right here. And so look at that, even right here. You're coming up, you come up, down, right, or you got the market starting to trend long, comes down, holds that expansion. Again, another clue, a clue helping you work out that range. Then we break out long, holds expansion, and then explodes straight upwards. Not that we know it's going to happen with this kind of aggressiveness, but the general expectation based on the weekly being green and seeing this, is that we are going to get some sort of significant price move to the upside. That is the general expectation. And it wasn't hard to work out. Of course, these opportunities aren't going to happen every single day. They may happen every day on different time scales, but what you want to do is by monitoring one or two or three pairs, you want to be there for when markets set up like this. This is where you get those weeks where you get a decent gain. Whereas if you're bouncing between 15, 20 pairs, you're never going to be there when the ATS assistant says, hey, come over, take a look at this. This is one of the pairs we're monitoring. And you see this, that's where you're able to leverage that information and go heavy if you want to. So it's important to go through the flow, go through the cycles of pairs, because you will be there for the sideways boring markets like the overall dollar CAD right now. But dollar CAD, after NFP comes out, you're going to have situations, they may not be this good, but they may still be pretty good maybe next week, the week after, and coming into the next NFP. The best trading weeks are in dollar CAD are always going to be after those big numbers are released, because those define the economics that are going to unfold for the following month until you get new numbers. And then if you get a series of good or bad numbers, that'll cause the market to trend over the course of months. So anyway, this is the kind of stuff we wait for. As of right now, Euro CAD, obviously 4 hours still long, so you're getting below. Yeah, this one, entry opportunity, come up, held below expansion means it's not going to go just yet. Dump that one at break even. If you're trading heavy, get below expansion. Okay, another opportunity, took out liquidity, could enter on those liquidity lines, back up through, just snap back, showing the market's getting pretty dirty. Now this is more interesting right here. We break out long, boom, below expansion, hold above previous expansion. That's the block work we're looking. We're looking for the building blocks. Showing a progressive move up on the 4 hour, much more interesting to enter right here. Control risk right here, much better. And now we're just looking at this point that we're going to eventually work our way through. If you stuck an entry down here or based off of this expansion, then you have a very strong position in this market. You've earned the right to wait through the sideways market, and in expectation we're going to break through this level and keep going. Only thing against this type of opportunity is that we're getting out of session now. But if you have a good enough position, you can ride through the Asian markets and the market close if you're significantly in the money. It just depends on how strong your position is. When we get people that are asking, we may get someone that sends in a screenshot or something that they're looking at and say, it may be at 1 o'clock in the afternoon, at least our time, which is basically when the markets are done. And they're like, I'm looking at, there's about to be an expansion here and I'm looking at entering the market. First thing we say is, well, if it's on a 5 or a 15 minute, wait, because you're going to enter a position that you're not going to be in the money on potentially for a long time. And you're going to have to ride it in through the multiple expansions that can happen in the London Open and New York session. So there's a high chance that if you open positions in the dead hours of the market, that number one, those positions aren't going to actually go anywhere. So you're going to be married to your screen, watching a position maybe slightly go in and out of the money, ruining the rest of your day. You're also going to be sitting there. You're going to be expose yourself to the up and down expansions that happen in the London, New York session that could potentially take your position out of the money. And if you were sitting there, you're probably going to be super tired because you've been babysitting this position so long, waiting for market activity to actually come back in. You're going to be mentally fatigued, but now there's going to be better opportunities for entry, and now you're just trying to navigate and not lose money. So good rule of thumb, don't enter the market out of session if it's a short-term trade. If you've entered a trade, now for instance, if you bought in here and you rode this up, you're so far up on that position, it's not going to matter, because if the market comes in, it's not going to expand more than this range if this trend is going to continue. So, in this situation, if you've rode this up, I'd stick your catastrophic stop loss in, down, let's say below these liquidity lines here. I'd stick it right here just in case you get some random market anomaly that snaps against you. And you've earned the right to stay in this trade because you're in the money. But don't go through the dead end of the sessions at a flat or a negative. It's not worth it if you're trading short term, meaning anything under a 1 hour chart for entry. Anything under a 1 hour chart, just your trade, you need volume, you need fuel in the market in order to get anywhere, and the fuel is not going to come in for those time frames until the London New York session. So all right, guys, I apologize if I couldn't get to some of your questions. Like I said, we're more than happy to answer your emails if you want to send them in. Again, it's support@tradeats.com. Some announcements. We are, as you guys notice, that we are trying to keep these on Tuesday at 10 a.m. Hopefully that's working okay for everyone. I know that we can't really land on a perfect time because we got people all over the world using the system. So I apologize for the people that are sleeping right now and have to watch the recording, but we appreciate you watching the recording. And again, we always offer to you guys, we're more than happy to look at your screenshots as well, and any help you need through email. We're happy to do that as well. If you guys haven't taken advantage of the forum yet, we're trying to put some content in there, and it's off to a little bit of a slow start, but we do have a forum. Once you are logged into tradeats.com and you can see the online course, there is a button at the top that says forum. You're now able to get into that, and you guys can post your screenshots, your trading ideas, everything related to ATS can be, a category can be created and everyone can comment on that and help build the community. So we encourage you guys to use that. All we ask is that you follow the rules. Make sure you keep it based on ATS methodology, nothing offensive, or don't put anybody down or anything like that. I know you guys are all grown people, but if you guys do break the rules, we will kick you out of the program and we will discontinue your subscription. So please be respectful and make sure that you guys are a source of encouragement and help and not discouragement to our traders. Okay. That being said, I thank you guys so much for being on the webinar, and we will see you guys on the next one. Most likely, as long as we continue, it'll be Tuesday, 10 a.m. Pacific Standard Time of next week. Until then, be safe, be careful on Friday. My opinion, take the rest of the week off, come back heavy next week. Just my opinion, but you guys will figure it out. All right, everyone, have a great rest of the week, and we'll talk to you soon. Thanks.